Combining the trend following characteristics of moving averages and the measure of recent price changes with the RSI, that can make for a good trading strategy because we're essentially looking to take advantage of a momentum move in price in the direction of the short-term trend. Before we get started in this video, please hit subscribe to our channel. That way you can be notified when these videos are posted up. Any questions or comments, you can pop them below and just make sure you hit the like button. We've always heard that if you can catch the turn, you can ride a big move in price. But let's be honest, catching the trend change, it's not always possible, right? It comes with more chance of failure. And this is actually more accurate if you're just trading moving average crossovers. But with a small bit of knowledge when it comes to price action and the increase momentum given by the RSI, we may be able to enter somewhere close to the turn. Now, there are no best settings. Okay, but there are shorter and longer term settings. For our purposes, since we're looking for a trend change with momentum, we're going to use a 5-period EMA and a 15-period EMA because we want to make sure that we're getting into a trade when momentum was strong enough to change the trend. So RSI is going to be set to 21 periods, and we're only going to use the 50 level as part of our trading conditions. When we talk about time frames, I prefer daily charts for setups. You're doing my work at night. I have a plan for the next day. That's just something that I personally prefer. Others, like yourself, you may prefer a more active style and use a lower time frame, like the 15-minute chart, the 5-minute chart. Now, intraday trading does come with some challenges, not only with the speed of movement, but also the tendencies that can happen around the open of the session. But it is always possible to catch the start of a trend day, which can lead to some really great gains on the day. Hey, look here, this 15-minute chart, it's in pretty good shape in this example. However, with lower time frames, we can expect to see some whippy price action at times. We can see that on higher time frames as well. But with the lower time frame, you're more susceptible to it. What's the trading strategy we're going to talk about? There is absolutely no need to complicate things. And all we're looking for is a crossover of the averages, the RSI above 50 for a long, and a trade trigger. So this is a daily stock chart. Traders note that price is trending lower. That's indicated by the averages. When price starts to move upwards, the RSI at A crosses over the 50 level to the upside on a larger candle than the previous ones. Now that larger candle closing in the upper half of the range is actually a really good sign of interest in this particular direction. Now, the cross of the RSI is not enough for a trade. Okay, at B, we see the moving average crossover gives us a bullish bias. The entry candle is at C. So keep in mind that we can only confirm the crossover near the close of the session or at the close. Now, in our example, price gaps up the next day, and you may not even be filled on this trade. And I could have cherry-picked an easy one, and I'm going to soon, but the fact is that gaps at the open are pretty common, and you should know how to handle them. Now, if you have time during the day, because some people do, to monitor their trades or potential trades, you would have seen the gap up in price. But also note that price did retrace to fill that gap on the same day. So a trader could have entered the daily setup intraday. Now, traders that can't look at the charts during the day would miss this setup. No big deal. Okay, hold that thought because we're going to cover that later. This is a picture perfect example. It's a 15-minute chart of the ES, and we have a setup. It's fairly straightforward. At A, the RSI is above 50, and that was brought up over 50 by that bullish candle at B. But I want you to note that X, because at the close of that candle, the 5-period moving average is under the 15-period average. Well, the setup requires, for a long trade, the 5 to be above the 15, which we do get at C. Traders can either enter at the close, or you can use a buy stop order over the high of the candle. And that is not bad because price does have to move through the high to trigger the trade. And you know that at least in that short term that you have momentum in your direction. But we can also be a little bit more conservative. So in addition to the entry criteria is price taking out a previous swing high for an uptrend and a swing low for a sell, of course. So this will give us a price action definition of an uptrend, higher highs and higher lows. And that can be confirmed once the higher swing low is met. This 15-minute stock chart is trending lower, begins to bottom. And as price starts to advance, you note that last swing now was made, that high. So that is your line in the sand for a trade entry only when all the other conditions are met. And what are those? The RSI crosses to the top side of 50 after the moving average crossover. Now, the basic aggressive entry would have had you entering at that point, but Using the swing level technique, we need price to break and close over that last swing high. And we finally get that at the black arrow. Now, what about add-on trades or re-entry trades, or if you miss a trade? I said already, there's going to be a time that you miss a trade. One thing we do not want is FOMO, the fear of missing out. But you need rules to get into a position, because knee-jerk reaction trading is the downfall for so many different traders. If you miss a trade, you got to get in sync with this strategy and use this technique as a re-entry instead of a add-on trade. So what's the difference? Well, if you entered at the first opportunity, you'd be in profit. You could use a larger position size on the add-on trade. Now, the longer a trend is in play, the more chance we have of seeing a deeper correction. Now, if the add-on technique that we're going to talk about is your first position, do not use full position sizing, because we want to mitigate the risk of a deeper correction. Now, this re-entry applies to new positions as well as adding onto your current position if that's your trading plan. Not everyone adds onto positions. The re-entry assumes you took part in the first trade, that you booked some profits, and this is a new position. In that case, you may want to go to full position sizing, but only you know your risk parameters and what you can stand. So this green check mark, it's a legitimate trade. On the right, we see a pullback in price. It breaches the moving averages. Note the averages did not cross over, and also that the RSI stayed above the 50 level. So a trader can use a buy stop order on the candle that closes above both averages and hooked up the RSI indicator. Now, in the middle, we see a trading range. And if you're an advanced trader, you can actually trade breakouts out of those ranges as long as the averages do not cross and the RSI is still above 50. That's advanced. Stop loss targets. Every trade needs an exit strategy. So let's begin with stop loss. In general, the last swing level or consolidation can be used as the initial protective stop area. This is Bitcoin. Use that as an example. It's a recent trade. It's a legitimate buy point off of the 4-hour chart. Prior to the trade, we have a slight consolidation, which provides us with an area to tuck our stop loss under. Now, I've mentioned in other videos about using 1R, which is 1 times your risk, as a profit target. It's actually a good way to test the validity of a trading strategy. You can add 1R plus a little bit to cover commissions. Now, this example here, obviously, it went to 1 times the risk and more. Here, we have a legitimate first entry, and the stop would go someplace under the consolidation prior to the trade. Since the main swing low is actually pretty close, some traders may opt for just a little more buffer room and use that for the stop. In the middle of the chart, the bottom average is breached and we get a close above the average. The stop loss would go below the swing low with a little bit of buffer room, because that's a legitimate trade. It could be a re-entry or it could be an add-on. Just don't complicate the stop loss position, okay? Just have it in place and make sure it's in a place that if it's hit, the trade probably is not going to work out. Talked about profit targets briefly, the 1R. There's no secrets for taking profits. A trader can use a trailing stop loss below the 15 EMA. You can use a chandelier trailing stop. You can use multiples of risk. You can use higher time frame, swing highs, swing lows. It doesn't matter. Just pick one. Some traders may actually just look for a crossing of the averages to the downside, or the RSI losing the 50 level. Just whatever you use, just be consistent, take your profits. Now, moving averages, they're really good to show an instrument in a consolidation, right? Just because of the calculation. So when we see the averages whipping around price, we know that the average closes are pretty close to each other. These are the kind of charts you want to ignore, and you want to wait until price breaks out of that range. If you just mark off the highs and the lows of the trading range, it's a pretty good practice, especially if you trade certain instruments on a regular basis. And when price breaks out and runs, well, that's essentially a first trade that you're going to miss. That you would look for the re-entry trade and trade at half of the position size, as we talked about. So in closing, when we have momentum in our favor, which is a rising RSI, and we see an increasing range of closes of price, that's our moving averages crossing, we can look to take advantage of pending momentum. If we add in the qualifier of a swing high or a swing low taken out, it solidifies that you are trading an instrument that is trending up, at least in the short term, right? It might be short-lived, or it could be the start of a long-term trend. We never know. So if you don't know that we're in a new trend move, well, it could make sense to consider trailing some of your position. That said, there is something to be said for just taking your profits at a multiple of your risk and just looking for other opportunities. It's all up to you as a trader. Anyways, hope you like this video. Any comments, pop them below. Make sure you subscribe, right? We really appreciate that. We'll talk to you soon.